here in the Hong Kong market, we saw some very dramatic ups and downs in the last few days. What do you think are the main drivers behind this very drastic situation here?
Right. Well, I'm not gonna state the obvious. You know, the Russia-Ukraine war, the sanction risk, the rate hike risk, commodity price, you know, rising sky high with inflation risk and all that. You know, I'm sure everybody has read about those. But what I really want to state here is there's so much fear of uncertainty in the market. And I think it is natural that everyone in Asia or foreign investors with money in Asia are in a risk-off mode. Right. Now, it is important here to note that no one comes to Asia or China or Hong Kong for dividend, for value. People come here for growth. So if there's no growth, if there's uncertainty with growth, they go away. So if you look at a lot of economists predicting a softer GDP growth in China, Omicron spreading around in China and Hong Kong, people are worried about growth. So smart money leaves and be in a risk-off mode. So I think it's as simple as that. And I always say Asia ex-Japan is a risk-on market, and a lot of other places, maybe even the US or Japan, could be a risk-off market. So in that sense, I think it's as simple as everybody's risk-off. No one sees growth here, and people just leave and sell down. And think about the 1990s in Japan. You know, money just left the country after the crash in 1989, 1990, and then you have the lost decade in Japan for so long, simply because people don't see growth in the country. So this time around, with terrible expectation in China, with uncertainty of policies, uncertainty of Omicron spread, uncertainty with where China stands in light of the Russia-Ukraine war, people just want to be on the sideline. But fortunately, as you may know, the Chinese government stepped out and pledged to support the market about 2 days ago. And that really changed the course of everything. And you could see the Hang Seng Index subsequently rallied 2,700 points. But today, things are looking softer again. I'm sure after 2,700 points of rally, people want to take some money off the table for the weekend and maybe play again early next week. So you could see a huge change in sentiment just because the Chinese government came out and speak up.
Right. So how does that change things for the medium-term outlook, especially in terms of international institutional investors?
I think in the short term, we haven't found a clear bottom yet, and certainly with the recent rally, it could be a dead cat bounce. It could be a trend reversal. We don't know until a few months later. However, what I want to add over the past 2 days is we get a very good reflection of the behaviors of different types of stocks in the market. If stocks rebounded over 20% over the past 2 days, these are technically stocks that have that are big market mega cap. Look at Alibaba and Tencent. They rallied 20% after the Chinese government's announcement. And you could see right away that for all those names that rallied so much during that day, they are the eye of the storm. In fact, I want to get away from those stocks. I'm not saying that you won't make money from those stocks, but I'm saying that those are the eye of the storm. People over the past 3-4 weeks have been saying how cheap Alibaba has been, how cheap Tencent has been, but no one cares about valuation in such a risk-off, uncertain environment. Whereas if you look at stocks that rally between 10 to 15%, you get a better mix of investor. You have the more prudent investors who care about valuation. You have the regular short covering. And you could see that in the tumble and in the rally, it was more orderly. So those are the growth stocks that the market looks at and because they are not the big, mega cap index component stock, they have a better valuation standard, a better mix of investors. So for me as a fund manager, I want to focus on that segment because I can control my destiny in a better way. For those stocks that actually rallied only 0 to 10%, those are the value stocks in the market. They didn't rally as much. Smart money want to pick them up and you could kind of classify them as the more value laggard play.
As for the 0 to 10% group, do you have a kind of a group profile of these stocks? What kind of companies are they? Obviously, they are not mega Chinese tech companies, but are they also, do they also mostly come from the tech sector, financial sector?
It could be anything. It could be small mid caps. It could be family controlled companies. It could be some other types of utility companies, not just in light and power. Mm-hmm. It could be domestic consumption names. It could be properties. So there's still a huge amount of stocks to pick for these beaten down or oversold value ideas.
So from this point of view, there are still very uniquely investment philosophies for the Hong Kong stock market. Unlike some international investment banks have predicted, the Hong Kong stock market hasn't just become another Chinese stock board amid all this turmoil.
Well, look, the Hong Kong stock market is the 6th largest in the world. Now, the first two being US, then China, then Euronext, then Japan, and we rank the 6th. And give us another 30% upside and we will regain the 5th place. So where will money go? Where will capital flow? I don't know where else. Are you going to go back to the US? Are you going to go into Europe? Or are you going to go into Japan, which is cheap, but there's no growth if you're a smart capital. But at the end of the day, you have to understand, Hong Kong is still a major market in the world. You need to find a market big enough to absorb capital. And Hong Kong is definitely one of them. So we cannot write off Hong Kong with some convenience excuse saying that maybe Hong Kong is over, Hong Kong is no longer an international financial center and whatnot. And not to mention all the ADRs, according to the news, will be listed in Hong Kong. Hong Kong will still be very dominant. Now, what I want to say is Hong Kong being a part of the Greater Bay Area, we are, as a Greater Bay Area, as an economic zone, we rank 11th, if not 12th, in the world's total GDP. We are larger than the entire Spain, larger than the entire Australia, similar to that size of Brazil. And by 2030, now this is not from me, this is from PwC, the GBA will grow into a 4.3 trillion GDP. Now, what does 4.3 trillion mean? It means we'll be bigger than Germany, bigger than the UK. Now, I think the idea or the assumption might be overly rosy. But I could say in 7-8 years' time, the GBA economy will definitely surpass France, Italy, and maybe matchable to the UK, if not Germany as well. So all in all, there's tremendous opportunity in the Greater Bay Area, and Hong Kong is part of it. And not only that, Hong Kong is still the international center, IPOing or listing a lot of these potential companies. So I am still very hopeful, and I won't write off this city or this exchange right away.
Perfect. A lot of the pessimism concerning the prospect of Chinese companies currently listed in the US being forced out and coming to Hong Kong to relist concerns the trading volume. Some of the analyses say Hong Kong lacked the kind of trading volume to support the valuation that would be satisfactory, or that would be even comparable to their US levels. What do you think about that? Would the trading volume also increase with more Chinese companies coming to Hong Kong?
Yes and no. Now, this time around, I won't be overly supportive of policies in Hong Kong. I think the Hong Kong government ought to do more to stimulate liquidity and trading volume in Hong Kong. Now, it's kind of surprising that instead of lowering stamp duty on stocks, right, the local government, because of COVID, because of a lack of tax revenue, decided to increase stamp duty on stock. I think that is not the best idea. And if we want to be an international financial center and to attract more international investors, we must lower stamp duty on stocks in the future. I'm not saying that you have to cut it to 0%, but definitely we have to cut it. Now, if you look at previous case studies, for example, in Australia, I think in the early 2000s, they cut the stamp duty on stocks by 50%. And after 6 months to a year, liquidity improved by 100%. Maybe even if there's not 100%, it's 50%. So there is definitely a positive correlation to a lowering of stamp duty to boost up more trading liquidity. Not to mention that, the world has become more digital. Proprietary trading, algo trading has become, or high frequency trading require a thinner spread. Mm-hmm. And nowadays, with brokerage commission being as low as 3 basis points, how dare the Hong Kong government increase the stamp duty and to increase the spread by over 20 basis points. So I think we ought to do something about it. And speaking about trading liquidity, you are absolutely right. The top 100 stocks listed in Hong Kong account for 70% to 75% of daily trading volume. The next 200 names, the next 200 biggest names account for the next 20% trading liquidity, leaving out close to 2,300 stocks in Hong Kong, fighting for 5% of trading liquidity.
I think I'll just wrap up with one last question. For the next few weeks and months, do you expect the market fluctuation to get better or worse?
You know what? I cannot predict the future, but at current valuation, I would say keep buying. Adopt a dollar cost averaging strategy, which is very simple. It's almost investing 101. And even as a fund manager myself, I'm not trying to bang for the buck and make some bold move. I am just going to pace myself and buy every single day whenever I see valuation being justified. So if I have $1,000, I'll probably spread my bets very thin and maybe spend it in the next 30 to 45 trading days. Experience and observations over the past have suggested that for any crisis, it takes about 7 to 8 weeks to truly mellow down. Mm-hmm. And so I would say let's say if the Ukraine-Russia conflict started on February 24th, I would say the market would begin to stabilize by mid-April. And maybe by mid-May, we will begin to see where the bottom is. And along the way, as long as I average down or average up and build a nice and solid foundation with our investment, I think that is more prudent than trying to predict what's going to happen next. But with that in mind, I would say that by year end, I'm not certain, but by year end, we should be better than today because valuation at current moment, it's almost at like negative 2.5 times standard deviation, negative 3 standard deviation, which doesn't happen all the time. And if you look at valuation at the current standard deviation, for the past 1,000 days, you may have only 50 days or 30 days with a valuation lower than the recent days. So am I going to wait for the one day that is the cheapest? Probably not. But if I'm telling you that for the remaining 950 days, the market tends to trade higher than now, then I will start buying.